As the summer winds down, there's a lot of data coming out that shows pretty clearly that the housing market is in a correction. But this isn't time to panic or to celebrate, maybe if you're waiting for housing prices to go down. This is the time where cooler heads prevail. There is a lot of nuance to all the information and data that's coming out that can help you become a better investor or a more informed home buyer. So that's what we're going to talk about today. We're going to parse some of the data that's coming out to help you make sense of what is actually happening, whether the market's crashing or in a free fall, and what opportunities might exist over the next couple of months. Hey, what's going on, everyone? My name is Dave Meyer. I'm the Vice President of Data and Analytics at BiggerPockets. I'm also the host of the On the Market podcast. And that podcast and the YouTube channel, which you can find in the link below, help bring insights about what's going on in the housing market to investors and home buyers just like you. So if you like this type of current events, data-driven information, make sure to go check out the On the Market channel. It has tons of videos and updates just like this. Also, I should ask, please give us a thumbs up. We do really like that. All right, let's jump into what's actually happening in the market. First of all, is it in a free fall? Is it crashing? No, that is definitely not happening just yet. But there are signs that the housing market is showing weakness, and a correction, which is basically a more modest form of a crash, is likely in the works. We see this reflected in a couple of ways. The first data point you should be looking at as someone interested in the housing market is year-over-year price data. So that basically compares July 21 to July 22, and you see what the price difference is. And right now, that is still up really high. It was actually 14%, which is pretty high. By some measures, I've seen some more recent weekly data that shows that it's fallen to about 7%, which would be a big drop down, but it is significantly up year over year. And the reason year over year data is more important than month over month data, which we'll talk about in just a second, is because housing market is cyclical. It always peaks in the summer, then it starts to come down a little bit, and then it goes back up starting in January again. So normally, if you compare August to September, September is going to be lower, even if the trend on the housing market is going up. So that's why we like year over year data, and that is still up. But even though I said that's the ideal way to look at the housing market, when things are changing rapidly, like they are right now, you should be looking at month over month data. And that is what's starting to come down. So we're seeing in many markets in the US that the highest price that we've seen was in June, and sales prices are starting to tick down in July. And this is really significant because over the last couple of years, the seasonality that I was talking about has really been defied, and housing prices just keep going up and up and up and up month over month. And that is what has started to change, because you're seeing, especially in markets on the West Coast, that housing prices are starting to come down 1 or even 2% month over month. And it doesn't sound like a lot, 1 or 2%, probably you're thinking, oh, that's not crazy, but that's just in a month. So if that really kept up, it could be kind of scary, right? Because you would see, in 6 months from now, you could have housing prices down 8, 10, 12%. And that is a very significant amount. That is more in the crash territory that some people think is about to happen. Now, the question, of course, is that going to happen? The two data points that I've shared with you so far, year over year and month over month data, are backward looking. And we need to start looking forward to try and figure out what's going to happen. And there's basically two data points that I really like to look at for forward looking. Those are inventory and days on market. I talk about this all the time if you follow my content elsewhere, but basically they're a good measure of the balance between supply and demand in the housing market. And if they start to go up, that indicates we are moving towards a buyer's market. Right now they're super, super low, which means we're in a seller's market. But things are starting to change a little bit, mostly in inventory. Inventory, which is basically the amount of properties that are for sale at any given time, is up 14% year over year, which is really significant. That's a lot of growth. But in historical context, we are still maybe 30 to 40% lower than it would be normally. So it is going up, but it is still incredibly low. And when you hear people say that things are not going to be like 2008 and a crash is unlikely, what they often point to is inventory. Unless inventory is sitting on the market, which essentially forces a seller to lower their price, people aren't going to lower their prices. Like if people are putting their house on the market and it's selling relatively quickly, then prices usually are sustained. Which brings us to our second point here, which is days on market. They're sort of closely tied together, right? When days on market are super low, inventory tends to be super low as well because something gets put on the market gets bought really quickly. Days on market is going up, but not really that much. It was at about 20 and a half days last year, and it's gone up to about 23 days now. So still super low. It's normally in the 40s or even 50s sometimes. And so we're about half the amount of days on market. So if you're looking at the national housing market, then there are conflicting things here, right? So year over year, prices are still up, but they're slowing down. The growth rate is slowing a lot. Month over month, things are starting to go down, which is pointing to maybe price declines. But at the same time, inventory and days on market are going up, but not really at a rate yet that I would consider at risk of a crash. That could all change. This is just my opinion right now in August of 2022, but that's what it's looking like right now, that on a national level, prices are starting to come off peak, but they might stay up year over year, at least through the end of this year. Hard to tell just yet what's going to happen next year. Now, of course, I'm just talking about the national housing market right now, and what you really want to be looking at is your local market, because real estate is local. We all know that, right? What I think is really notable here is that what I have been talking about, and a lot of people who I know who are great housing market analysts talk about, is that we're going to start seeing sort of a split in the housing market. It used to be over the last couple of years, everything is going up, right? Everything, no matter where you live, it is just going up at double digits. Rent is going up. Everything's great for people who own property. Now, I think we're going to start seeing the housing market split. And we're going to see some markets start to go up even more, probably at a much slower rate than they have over the last 2 years. And we're going to start to see some markets go down, but probably not at the same rate that they went down in, first, let's say, 2007, 2008. This is just based, again, on supply and demand. If you look at certain markets, you're starting to see huge amounts of inventory. One thing that's really notable is that in San Francisco recently, inventory surpassed pre-pandemic levels. So to me, that means that market, it's back at pre-pandemic levels. Prices are super high. Affordability is really low. We're going to probably see price declines in San Francisco. A couple other cities that stand out there are Phoenix. We got Boise. We got Austin, Fort Myers, Reno. They're all seeing big increases in days on market and inventory. Remember, those are our two forward-looking metrics. So if those things are starting to go up, that means that in the next couple of months, we'll probably see prices start to decline. So those are a couple markets I am more concerned about. On the other side, you see markets like Miami, Philadelphia, Hartford, Connecticut. They still have a super low inventory. They have super low days on market, and it's simple. It's supply and demand. Demand is outpacing supply, and that continues to push markets up. So when you hear these headlines or read these headlines that say that the market is crashing, is it true? First of all, no, it is not crashing. Is it correcting? Yes, I do personally believe that we are in a correction. The housing market needs to slow down and get back to that 2-3% year-over-year growth rate. That is a healthy housing market. I know a lot of people think like, oh, real estate investors want housing prices to go up indefinitely. That is absolutely not true. It is a much more predictable, better market for everyone in the whole country if it just goes up at a slower rate. And I think we're heading back towards there. That said, certain markets are going to keep going up. Certain markets are going to decline. So that's where you have to go and do your own analysis. You know, I've mentioned a couple markets here for you, but I can't go over every single market in a 10-minute YouTube video. And as an investor, it's sort of your job to go do the research. So here are the things that I would look at. First and foremost, check out year-over-year price growth. I looked at the top 250 markets, and I can tell you right now, not one of them is negative. Every single one of the top 250 markets in the US right now still has positive year-over-year growth. But you can check out how fast it's growing, right? In Austin, for example, last year it went up 45% year over year. Now it's 20% year over year. That's pretty significant. It's still up a ton, but it's slowed down a lot. So definitely check that out. The second is month over month data. And we did see from June to July, some things started to come down. So what happens from July to August, the data won't come out for another couple of weeks, will be really significant because we'll see if this was just a one-time thing and it flattens, or is this a trend and we're going to start to see prices decline month over month for the next couple of months. So far we got year over year, month over month. And then my last two are the things I talked about as leading indicators. You want to see inventory. Are they starting to approach pre-pandemic levels? If so, that is a big red flag to me that prices might start to come down. Same thing with days on market. If days on market are ticking up at a solid clip and approaching pre-pandemic levels, this is another indicator that prices in your market might start to come down. I should caveat all this is I'm mostly talking about residential here. I'm mostly talking about single families and small multifamilies, 2 to 4 units. If you want to look in commercial, that's valued in a much different way. And so that's what I'm talking about here. The other thing, this is just a little bonus before we go to keep an eye on, is what's going on with construction, because some data came out that just showed that the number of homes that are selling, that new construction homes are selling, is down a lot. It is just sort of down almost 30% year over year. And that to me is a bit of a concern, because if new construction isn't selling, builders, they have to move that stuff off their books, and they're probably going to start slashing prices. And so that could send some ripple effects through the economy. It probably means that builders are going to stop building as much as they have been, which could further exacerbate the housing supply shortage that we have in the United States. So new construction is only a small fraction of the larger housing market. So even if it goes down a little bit, that doesn't mean the whole market is going to crash. But I think it's going to be really interesting to see if newly constructed homes start discounting at large rates and for how long that lasts, because that could also throw a wrench in the rest of the housing market if it is pretty significant. So that is my read on the housing market, where we sit in the middle towards the end of August 2022. Housing market in a correction, probably moving towards a healthier housing market. But the next 6 to 18 months are probably going to be really volatile, and we're probably going to see this split in the housing market that we've been seeing. So do your own research and figure out if the markets you invest in or the markets you're considering investing in, which way that they're going to head. All right, that's it for me. Again, my name is Dave Meyer. If you want to interact with me, there are two great ways to do it. First and foremost, I just wrote a book on BiggerPockets, and if you want to learn how to do this type of data analysis and learn how to underwrite deals like an absolute pro, you can check that out. It's called By the Numbers. You can find it on BiggerPockets.com, or just go to BiggerPockets.com/bythenumbers. Or if you want to just interact with me, have any questions about this video, you can do that on Instagram, where I am at the Data Deli. Thanks again for watching. I'll see you again soon.